This is the daily fiscal pulse for the 29th of July, 2026. Remember, we're looking back one day here. Everything in this report reflects conditions as of Wednesday's close, not real-time data. Let's set the stage for what's happening in markets today. Right now, the story is all about artificial intelligence and technology stocks. You're seeing headlines like Amazon stock soars 9% on booming cloud growth. Revenue beat, and that narrative is clearly moving price action across the board. Of course, it's always worth cutting through the headline noise and focusing on what the actual flows are telling us. The headline number for today is straightforward. Net fiscal transfer landed at $4.5 billion. That's reasonable on the surface, but what really matters is the trajectory. Over the last 5 days, flows have decelerated to roughly half their recent pace. The story here is tax receipts, which came in at $14.9 billion and did the bulk of the work. That pattern shows up clearly in the ES futures contract. We closed at 7,350, and that's sitting noticeably below the 20-day moving average of 7,527. The 20-day range spans 282 points and is pointing downward. So on both the flow side and the price side, we're getting the same message. Things become more revealing when you step back a bit. The 5-day average for government spending is running around $4.5 billion daily. Stack that against the 20-day average of $6.3 billion and you spot a meaningful deceleration. Less cash is flowing into the economy, less money reaching households and eventually the markets. That's tightening financial conditions. The year-over-year picture reinforces this. Spending sits at roughly $1,316.4 billion with no meaningful change in fiscal support to factor into your analysis. If you're thinking about taking a long ES position, this backdrop deserves consideration. The fiscal regime isn't working in your favor here. Our conditions gauge is sitting at -84, but context matters enormously. We've navigated similar setups many times, and despite lighter liquidity, the S&P has historically averaged around plus 1.5% over the following month. Markets don't always move in lockstep with liquidity. They can grind higher regardless. Margin debt adds another dimension to this. We're seeing it at the 100th percentile, which is elevated territory. Historically, when you see levels like that, it functions more as a caution flag than a buy signal. Practically speaking, here's what that means. With fiscal flows running below year-ago levels, there's less shock absorption in the system. When headlines turn positive, equities can still creep upward. But when risk events emerge, whether that's AI or tech sector volatility, moves to the downside can accelerate simply because there's less liquidity ready to catch the fall. A couple of dates worth flagging as we look ahead. Month-end settlement comes on the 31st of July and can reshape short-term flows. The next significant Treasury coupon interest payment window opens around the 15th of August. Fiscal headwinds are clearly visible in the data. That said, the rate of tightening could be stabilizing. What happens next really hinges on how these scheduled flows materialize. That's where the opportunity sits right now.